So impact investing falls very much on the continuum between philanthropy and traditional investing, where we're investing only for returns. The difference between ESG and impact investing is that ESG really is about negative screening. So you're avoiding companies that do bad in the world, that impact negatively on the environment, or that sell arms or tobacco and alcohol, whereas impact investing really is about positive screening, where you're actually physically going out and consciously looking for companies that do good in the world. So companies not only that are going to offer you a financial return, but also an impact return, so perhaps create jobs, deliver water to villages, impact on the education in the country. There are lots of barriers to impact investing. I would say mostly education, or telling investors about what exactly impact investing is, and managing their expectations. So traditionally, impact investing is much longer term than, for example, listed shares or listed bonds. And to ask an investor to put away their money for a period of 7 to 10 years, as opposed to potentially getting it out the next day or the next week, the next month on the stock exchange, it really makes it a difficult investment. And then, of course, there's also the administration and the regulation, and it's costly to do impact investing. There's a lot of due diligence that goes into impact investing. So I would say if we were able to educate and to minimize regulation, or put regulation in place that encourages impact investing, that would be a huge benefit to the country. So as a country, we have so many areas that we need to fix, and impact investing is not necessarily going to change everything overnight or to transform the country immediately. But what it does do is that it brings private capital into a space where potentially government or public don't have money. Impact investing, or the areas of impact investing that are impacted or can be changed, really is driven by the capital allocator. So you would want, as an investor, you would want it to be decided where your money is going to make a difference. For example, I'm very keen on education, and I would like an impact fund that focuses on educating the youth and educating children, building schools. And of course, it's a difficult area to be investing in, because you really want to touch the very bottom, the very difficult part of society, and then to get a financial return out of there makes it a little bit more difficult. But understanding that with impact investing you can do that, I think that's where the benefit or the opportunity lies. The reason we haven't had such great take-up in impact investing is a couple of things. One is education. So people either see themselves as investing for profit only or donating, and impact investing really lies in the middle. So it's an educational process. And then secondly, because it is expensive to do impact investing, and investors need to understand that, one, they need to lock up their money, and potentially that they may not get the returns if they want the absolute, so the core of the impact, they may not get the returns that they're potentially going to get from a listed stock exchange. So this is a very difficult question. For retail investors, it's an educational process, and retail investors need to understand exactly what impact investing is. And then also we need a vehicle to offer retail investors. So at this stage, I would say probably the lowest or easiest route for a retail investor is some of the big corporations perhaps offering a unit trust or a listed vehicle where investors can put their money in and take it out as they see fit. And then, of course, somebody needs to offer a market. You need a big bank or a corporation or the stock exchange themselves to actually make the market and offer liquidity, which I think is one of the issues with retail investing, is that you need liquidity.